For our second example, we're going to do the same thing in the first example. We just have the information laid out in a different way. So we have all of our standard amounts, and then we have information about our actual results in this paragraph here. So first we want to look at the materials price variance. So remember, the materials price variance is the actual quantity used times the difference between the standard price and the actual price. Well, we have the actual quantity used here and our standard price. What we aren't given is the actual price. So we need to look for our actual price of materials. We are told what we paid for the total cost of materials. So our total cost of materials was $593,800. If we divide that amount by the materials used, 148,450, we get a price of $4. So we're going to take, for our materials price variance, we'll take that 148,450 pounds times the difference between what our standard rate was and what we actually paid. So $4.20 minus $4. So we have a materials price variance of $29,690. We paid 20 cents less a pound than we were going to. So we have a favorable variance. Now we need our quantity variance. So for our quantity, we know what our actual materials used were, 148,450. So we need to know the budgeted amount of materials. So we have the standard quantity allowed per batch is 1,020 pounds. We produced 147 batches. So 147 batches times our standard quantity of 1,020 pounds per batch says that we should have used 1,940 pounds of materials. So we take our rate of $4.20, our standard rate, times the difference between what we budgeted and what we actually used for direct materials. We then get a materials quantity variance of $6,258. That is favorable. We add those together to get our total materials variance, and that total variance is a favorable variance. Next, we look at the labor rate variance. So our labor rate variance is the difference between what we budgeted to pay and our actual payment times the actual labor hours. So we have that we had total labor costs of $17,600 for work of 2,200 hours. So we need to figure out our actual rate of labor. So we're going to take our actual cost of 17,600 and divide by our total hours of 2,200. So we get an actual labor rate of $8 an hour, and our budgeted rate is $8.50 per hour. So we take our actual hours, 2,200 hours, times the difference between our budgeted rate and our actual paid rate of $8 per hour. We get a labor rate variance of $1,100, and that variance is favorable because we paid 50 cents less an hour than we budgeted. Now our labor efficiency variance. How many hours did we use versus how many hours should we have used for our level of production? So it says we produced 147 batches and that our budget is 14 hours per batch. So budgeted labor hours, would be our 147 batches times our 14 hours per batch. So our budgeted labor hours were 2,058 and our actual labor hours were 2,200. So we take our standard rate of $8.50 per hour for direct labor times our budgeted labor hours minus our standard, or what we actually used. And we get negative $1,207, which is an unfavorable efficiency variance. We add these two variances together. We have a total labor variance that is unfavorable and is negative $107. Something that can explain a positive rate variance and a negative efficiency variance would be if we had newer employees on board. So they would make less than employees that we would have for a long time, which can explain our cost savings. But they would take longer to do things, which can explain the more number of hours versus what we had budgeted. Now let's look at our spending overhead variance and our volume variance. So for our overhead variance, we need our actual overhead costs, which are given here. Actual overhead costs are $3,625. Then we need to know what our budgeted overhead costs were and what our applied overhead costs were. So budgeted overhead and applied overhead. Well, our budgeted overhead is fixed overhead of $2,800 and variable overhead of $9 per batch. We produced 147 batches. So 9 times 147, $1,323. So our budgeted overhead total is $4,123. We actually spent $3,625. So the spending variance is the difference between our budgeted and our actual of $3,625. Gives us a variance of $498. We spent less than we budgeted, so that is a favorable variance. Next is our volume variance. So our applied overhead rate is $29 per batch. We apply overhead at the rate of $29 per batch, and we made 147 batches. So 29 times 147 gives us applied overhead of $4,263. The difference between what we applied and what our budgeted, or $4,263 minus $4,123, is $140. So our total overhead variance is $638, and that is a favorable amount. So now we've seen two examples for calculating variances. The equations to calculate the variances are the same between the two examples, but where the numbers were located in the information given was different. So look for that sheet of equations in your textbook on how to calculate each of the different variances as a reference.